Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a look at three companies that are making headlines in the market: United Parcel Service, Novo Nordisk, and Adobe. According to a recent article, these companies are being considered as potential buys due to their strong performance and growth prospects. United Parcel Service, for example, has been experiencing steady demand for its services, while Novo Nordisk has been benefiting from its position in the healthcare industry. Adobe, on the other hand, has been investing heavily in artificial intelligence and design software, which is paying off with strong revenue growth. But before we get too excited about these companies, let's take a closer look at their financials and see if they're really worth considering. Adobe, for instance, has just released its annual results, which show upbeat revenue and profit forecasts due to the strength of its design software and AI offerings. The company is expecting annual revenue between $25.90 billion and $26.10 billion, with adjusted earnings per share of between 23.30 and 23.50. It's also worth noting that Adobe is facing increasing competition in the industry, particularly from rivals who are using AI to rapidly grow their businesses and win contracts. However, the company seems to be holding its own, with strong growth in AI adoption and a significant increase in monthly active users for its freemium offerings. As we consider these companies as potential investments, it's essential to remember that the market is constantly evolving, and what may seem like a sure thing today could change tomorrow. So, let's keep a level head and take a balanced view of the situation. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're diving into the world of tech and finance, where the lines between innovation and investment are constantly blurred. Today, we're examining the latest developments from Oracle, a company that's been making waves with its ambitious plans for AI cloud data centers. Now, I know some of you might be thinking, Oracle? Isn't that just a legacy software company? Well, think again. Under the leadership of Larry Ellison and CEO Clay Magork, Oracle has been aggressively pursuing a strategy to become a major player in the cloud computing space, particularly when it comes to artificial intelligence. The company's recent earnings report provides some valuable insights into this strategy. On the surface, the numbers might look a bit mixed. Oracle reported total revenue of $16.06 billion, which fell short of analyst estimates. However, adjusted operating income came in at $6.7 billion, and the company's cloud business showed some promising growth. But here's the thing: Oracle's plans for AI cloud data centers come with a hefty price tag. The company is expecting to spend a whopping $15 billion more on capital expenditures than previously estimated. That's right, folks, $15 billion. This has raised some eyebrows among investors and analysts who are wondering how Oracle plans to finance these massive investments. Now, I'm not here to speculate or spread rumors, but it's clear that Oracle is taking a bold bet on the future of AI and cloud computing. The company's deal with OpenAI, the creator of ChatGPT, has sent shockwaves through the industry, and many are wondering what this means for the future of tech. As we delve deeper into this story, it's essential to consider multiple perspectives. Some might argue that Oracle's aggressive spending on AI is a necessary evil to stay competitive in a rapidly evolving market. Others might caution that this level of investment comes with significant risks, particularly if the company fails to generate sufficient returns. As your host on the Riskwiser Zone, my goal is to provide you with a balanced view of the situation without taking sides or promoting any particular agenda. So, let's take a step back and assess the facts. Oracle's plans for AI cloud data centers are undoubtedly ambitious, but they also come with significant challenges and uncertainties. As we move forward in this rapidly changing landscape, it's crucial to stay informed and adapt to new developments. The intersection of technology and finance is a complex and ever-evolving space, and we'll continue to monitor these trends and bring you the latest insights right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, I want to shift our focus to a crucial aspect of investing that often gets overlooked in the pursuit of high returns: managing risk and finding stability. In today's volatile market environment, it's more important than ever to have a well-diversified portfolio that can weather any storm. We've been discussing various strategies for achieving this balance, from asset allocation to hedging techniques. But one often underappreciated tool in the investor's toolkit is the humble bond ETF. These exchange-traded funds offer a low-cost, efficient way to gain exposure to a broad range of fixed-income assets, from government bonds to corporate debt. Our story today highlights 3 top bond ETFs that are worth considering for investors looking to add some stability to their portfolios. The Vanguard Total Bond Market ETF, the iShares Core US Aggregate Bond ETF, and the Vanguard Short-Term TIPS ETF all offer unique benefits and characteristics that can help investors navigate the complexities of the bond market. The Vanguard Total Bond Market ETF, for example, provides broad diversification across the entire U.S. bond market, with a dividend yield of nearly 3.8%. The iShares Core US Aggregate Bond ETF offers similar exposure, with an expense ratio of just 0.03% and a slightly higher dividend yield. And for investors looking to protect their portfolios from inflation, the Vanguard Short-Term TIPS ETF provides a unique solution, with payouts that fluctuate with the rate of inflation over time. While these bond ETFs may not offer the same level of excitement as some of the more exotic investment opportunities out there, they provide a solid foundation for building a resilient portfolio. And in today's uncertain market environment, that's more important than ever. So if you're looking to add some stability to your investments and reduce your risk exposure, consider taking a closer look at these bond ETFs. They may not be the most glamorous investment options, but they can provide a steady source of returns and help you sleep better at night. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.